Welcome everyone back to Pete's Investing and Trading website. Here we look at some key world market indices, China and Australia in particular, we're going to focus on and see how the Chinese market is reacting to the Evergrande crisis that's ongoing. First, just remember to subscribe to the channel, hit the notification bell and the like button, and review our indices, playlists, the blue chip share review playlist, and also the strategy playlist. Under the strategy playlist, that's where we keep all our strategy videos and for further reference and a better understanding of how they work. We're not offering financial advice, it's purely an educational video series. We track and trade on a 15-minute time frame and also daily charts. In this particular video, we're going to be focusing on the daily charts. We track and backtest revenue over drawdown. That's important. We want to make sure that the revenue is giving us better benefits compared to what drawdown we may be impacted by. And backtesting transacts with 5 contracts per trade. So again, we're trading with CFDs in this case, in this example. We're trading on 5 contracts for each of these indices. And finally, dividends are not included in our backtesting. So where we're going long and they pay out dividends, dividends are not shown up. So anything we get back in dividends does add value to our bottom line. So let's get started. First, I want to show you the quick summary of our results for these indices. And again, we're following the Australian market, the US market, Germany, the FTSE, China, and the gold index. And we're using this entry-exit strategy, using the Alligator and Fractal and Awesome indicator as an entry point. So if the Alligator lips, i.e. the green line is greater than the teeth, the red line, we enter the trade. As well, the close must be higher than the Fractal, and the Awesome indicator must be greater than 0. We exit the trade when the close is less than the Alligator teeth, and our minimum gain is what's achieved over the last 100 bars in terms of high-low ranges. So we take that and we multiply by 0.5, and that's our exit strategy. I'll give you an example of that in a few minutes. And lastly, our average down process. That's where we look at adding more to our positions where the close is less than the average price, obviously. In other words, the price is going against us. The Alligator teeth are greater than the lips are greater than the teeth. The close is greater than the Fractal, and the Awesome indicator is also in a positive. But we also must make sure that we have lost the equivalent of a last 100 bars high-low range multiplied by 0.5. So it's basically the opposite of this one. That's a bit convoluted, but I'll explain that again, how that works in a demonstration. These are the results we've hit since trading backtesting since start of 2007 on a daily chart. So that's the revenue, and that's the drawdown we've achieved for each of these. And that just calculates out what it achieves on a per monthly basis. So we want to try and achieve the highest percentage of profit over drawdown. So let's quickly show you the ASX first. I'm going to show you how these are performed. The ASX and the China market are performing. So this has been doing quite nicely. It come and bounced off this moving average 200. Again, we're not trading the moving average 200, but just using it as an indicator in terms of progress and trend. It's come and bounced off that moving 200, and it's also broken above the, you can see there the green line of the Alligator teeth is broken above the red line, and our Awesome indicator down here is broken above 0. Okay, we're connecting to our VPN. So once that happens, we enter the market. You can see here that was an actual case where this backtesting entered the market. The Alligator teeth, the green line is above the red, and the Awesome indicator is in the positive, and it's also broken above the fractals. So that's in what's happening in the last couple of months in terms of the ASX. I'll quickly show you the China market. Now this has been tracking down in this triangular downslope here, and it's finally broken above this downward trend line. Not getting too excited, but you can see there it's broken above, and it's trying to ease away from that at the moment. So fingers crossed that continues in the uptrend and it moves in the up direction. You can see here we've entered our first lot of shares back, our first lot of contracts back here. The second lot was entered there, and our third lot was entered there. You can see that the profitability line is starting to turn in a bit of an upward trend. Let's go quickly back to the ASX, and I'll explain the trading strategy and how that works. So again, let's look at this little example here, where we enter the market there, and we exit it up here. So again, our entry strategy is where the green Alligator teeth, it breaks above the red, As you can see there in that little area there. Also, the awesome indicator breaks above 0, and our close breaks above the fractals, and that's indicated by that grey area there. That's a fractal. That's where we enter our first lot of contracts. Now this is going in our favour. It's kept going, and it closed out at this point there. Now, why did it close out there? Remember, our exit strategy is when the green line breaks below the red, and it starts moving down. Now, it happened there as well, but the reason it didn't close out there is because it was still within this range. So this is our high-low range of the last 100 bars, and that's what this dotted line calculates. So at each of these points, it calculates the values. So you can see there at that where it actually closed out. Down here, the last 100 days was 428 points. So what we do is we measure 428. I've done it here. It's the manual drawing of this ruler. That's 426. It's close enough. So anything within that range, it won't close out, even if the teeth break below, and that's what it's done. In this case, it was still within that range and hasn't closed out. So it keeps rising. Now it's above that point there, and it finally closed out there because it's broken above our minimum range. We want to get that minimum range of profitability. So that's our exit strategy. Now let me show you the average down approach, and that explains in this little area here. Okay, so we enter the first lot of shares there, first lot of contracts, I should say, 5 contracts, but the price went against us. And again, you can see here using this high-low range, that's at 271 over the last 100 days. So that's about 276. Let's keep it as a ballpark. So it must break below that, and for like entry criteria to then be met again. So it's broken below that, and part of our entry criteria again is the alligator teeth breaking to the 0, and also the awesome indicator breaking above 0. It hasn't done that there. That's why it didn't enter any more contracts there. Price kept going down. Then finally the alligator teeth broke above again, the green above the red. That's what it's done there. But in this case, the awesome indicator broke into the positive, into the 0, above 0. Also, it broke above the fractals, that grey area there. So even if it was that awesome indicator was above there, and the green line was above the red line there, it still wouldn't have broken above because that was still below the fractals. So the entry criteria needs to meet those 3 entry criteria to add more contracts to this. So that's what it's done there. The awesome indicator is greater than 0, broke above the fractals, and the alligator teeth are in the green above the red. So added 5 more contracts to this position. So what I've done here, I've drawn this little calculation. That there was 5 contracts at 6302. That's 6302. Entered another 5 contracts at 5743. So 6302 plus 5743 divided by 2 entries gives us 6023. And that's defined by this dotted blue line. That is now our new average price. So it goes from that point there initially. After we enter that second lot of contracts, the new average price is that dotted line. So then we take the measurement of this minimum contract requirement. So you can see there the average last 100 days is starting to rise. So we now recalculate the new one, and it finally exits at that point there. You can see there it exited 10 contracts, 5 at 6423, another 5 at 6423. So again, you can see there on the dotted line, the calculation was the last 100 days, 378. And that's what we measure that from that average line. We measured 378. So we need to break above that to exit. So even though the green broke below the red there and broke below the red there, we're still in a positive, but not to our minimum requirement. The reason we use this last 100 days average high-low range is because we want to calculate based on the respective chart and respective time frame. So if you were to trade this on an hourly time frame, that calculation would be different. That's why we don't use arbitrary percentage gains or losses. We use calculations based on the actual price of the price chart. So that's our average down process, our entry, our average down, and our exit on the average down process. And just looking at the bigger picture for China, you can see here it's been doing quite nicely until we got hit to the COVID pandemic at the start of 2020, and then it started rising from there, and now we're making a bit of a hiccup. And this is again, this is the ASX, and it's been recovering up there. The China market, looking at the longer term, it's been doing quite nicely as well. bounced off those two resistance and support lines. It's struggling to break above that, and that's looking good so far. Okay, don't forget to hit the subscribe button, the notification bell, review the channel playlist. I'll speak to you in a future video.